Welcome back to Hedge Fund Manager. I'm Karl-Mikael siding. So for today's CAGR calculation for Equinor, I've prepared something slightly different. As I told you in a previous video, you don't always have to go 4 years into the future. So for today, instead of assuming normalized numbers 4 years into the future, I'm going to estimate the total return CAGR directly using the deltas for F, V, and D. So that is the expected annual changes in percentage terms for fundamentals, for the valuation multiple, and adding the dividend yield. So again, remember that the general idea here with the PFV framework is to break the returns down into a few other factors that we understand better, that we have maybe a direct, intuitive understanding of. The 4-year, let's call it EPS and PE method, the typical PFV method, that is just one special case of this change per year for each of these subcomponents type of approach. So in this case, we were trying to get at the fundamentals for Equinor, and unless you assume something special for the oil price, unless you dare be a commodity professional analyst, then you should just assume more or less status quo for the oil price. It could go down, it could go up. There is a risk inherent in the oil price and in the geopolitics that govern oil prices, and whatever happens to renewables like solar and wind power and nuclear even. We don't know those things. So in this case, in Equinor's case, we should assume that they will not, since they will not expand their volumes significantly, we simply assume that they might grow with more or less with an average inflation rate. So I would say that their fundamentals, and that could be sales, as we saw, pretty stable, or earnings per share, pretty stable, or their actual book equity, so their net asset base, that these are, well, they might be growing slightly. So let's call it 1 to 4% per year, maybe slightly more than inflation. The equity or the profits or the cash flow, it actually indicates that they should be able to do more. But as our base case, we should be a bit conservative. But there is definitely an optionality in terms of the oil price. Here at 60, it's pretty low from an historical standpoint, and just recently it was clearly above 100 for some time. Valuation multiple is probably pretty flat over the coming years. There could be an upside potential from price-earnings ratio of 7.5 times, but I don't think it's something that we should include in our base case. And the same goes for EV to sales, that is currently at about 0.65 times. There is a 50% one-off upside to around the 1x level, which I think is reasonable for a company like this. I mean, they actually do have a profit margin of a net income profit margin of around 9%. Which definitely warrants a higher than 1 times multiple if they were to grow with the economy, which is something I don't expect them to, but they could. And there is an asymmetric risk on the upside for both their net income margin and their growth rate and the levels, the price level of both oil and their revenues and their growth rate. So there is sometimes, as in 2022, you should see spikes of optimism for the share, and that in itself warrants a certain type of valuation multiple today. In any case, for our base case here, we should assume that the valuation multiple is flat the coming years. Fortunately, the cash flow yield and the dividends are excellent. So that's where we get our value from a company like this. They are in a kind of runoff or just biding their time to see what the future holds. For now, nobody loves the oil companies. That's why they are so cheap. But that also means that perhaps you shouldn't chase after a company like Equinor. Maybe there are better alternatives, but we'll come to that. Anyway, our calculation now for the total return CAGR for Equinor, it comes down to we have the fundamental base, so sales, assets, earnings per share, for example. Let's call that we can expect about a 3% annual positive change. Then it's the V part, the valuation multiple. If that stays constant, we could expect simply a 0% additional annual return. But what we actually could get here is a one-off, like 50% re-rating. It's not hard to imagine it going to like 10, 11 times earnings, or going from 0.65 times EV sales to 1 times EV sales. So there could be a 50% one-off re-rating here. But then again, over how many years should we expect that? Well, maybe over a long cycle of 10. So that actually comes to maybe 3.5 or 4% per year in addition, because of the compound effect. So maybe we could expect like an optionality here of 3 or something like that in addition. But let's not go there right now. And that means that we only have a 3 plus 0 plus the dividend yield, the annual dividend yield of 9%. And it all comes to a total return CAGR per year, starting now, of 12%. But sometimes, of course, it will be much higher than 12%. Perhaps not, of course, and we can't be really certain, but there is definitely an interesting potential and optionality for one-offs here. The question is, are we patient enough to just wait it out? Because there's really no way for us to point to a future year, let's say 4 years hence, where the normalization is likely to occur. We just simply can't do that. Rather, there is a risk of regulations, politics, the renewable mafia, if you like, that points to a non-normalization one-off negative event in the future. There's definitely that type of a risk. So here I've tried to summarize a couple of these risks: environmental regulation, oil prices. I mean, they can go down as well. They can actually be regulated downward with taxes. And of course, on top of it all, we have the risk of recession, and we also have kind of an unknowable and unquantifiable risk of the US losing its dollar hegemony. What does that entail for oil prices and oil companies? On the other hand, the opportunity, we saw that just the recent few years. There could be an energy crisis if the sun doesn't shine, if the wind doesn't blow, if nuclear plants aren't expanded quickly enough, then we could see much higher oil prices, because that is, oil and gas is where you have the most reliable energy available for when the renewables don't deliver and we don't have batteries enough to store long-term renewable energy. Actually, the more you build out the sun and solar, the more oil and gas you need, or nuclear plants. Those are some of the risks and opportunities that we need to add on top of our base case CAGR calculation of 12%. The question now is this enough to warrant an investment? Well, let's zoom out a bit and look at Equinor's long-term stock price. Looking back 25 years, we can see it's not long ago that Equinor's share price actually hit record levels. It came from a bottom here of less than 10 and went all the way up to above 40. So you got a 4x return in just a few years. That could happen again. There is nothing logical against it, but we could also revisit these low points of 2008, 2016, and just recently 2020. We could go down there again. So we have a 50% downside and maybe a 50 to 100% upside in the extreme case. So we have a couple of key questions here that we really can't answer right now. It has to do with, can investors return to the sector? And it's been unloved for quite some time now, and it's also been called as being too unloved, and that it's really about time you bought into it, and still nothing really happens. And now we are facing probably a recession, and all the money is going into AI and technology and future growth, secular growth, rather than this stale old commodity industry. So it's difficult to find a really positive factor or argument for a company like this. Once we come to this stage and we see that it is interesting, it is kind of cheap, but is it the cheapest? Is it the best stock we can find in this category? So I made a bubble search in Finviz. I noticed that Equinor actually is the one that has been growing quickly and has actually the lowest price-earnings ratio of a lot of oil companies. But then again, maybe it's still a value trap. Maybe it really has these specific good reasons to be this cheap. And that's why we should compare it to a diverse set of low multiple companies. For example, Petrobras or Mineros. We should look to oil, other oil companies. We should look to gold, to uranium, to silver. Maybe those are actually more interesting resource companies, and maybe we can find stocks that are even cheaper and where it's easier to foresee a higher resource price, not least gold or silver, and even uranium. And that takes us to our final lessons of today's deep dive.